This is a lecture from OpenTuition.
Okay, so let's go through and have a look at the past exam question that's called Haverford. You'll be able to download it from the ACCA website. So whether you're looking at it as a paper-based exam or whether you're looking at it as a computer-based exam, you'll find that Haverford is the question that has been provided to us from either the March or June 2018 sitting. Okay, so get yourself a copy of the question and away we go and see what we can work our way through. So first thing with every question that you have, make sure that you read the requirement. So you can see the requirement there has 3 parts, A, B, C, and in total they are worth 20 marks. Okay. First part, part A, wants us to work out the adjusted profit. 6 marks in total. We need, is it the 50%? So 3 marks to go through there and pass. Part B wants us to look at the statement of changes in equity. Okay, so looking at how equity shares, share premium, retained earnings, revaluation surplus, or parts of those other components of equity have changed from the start of the year. So here will that be the 1st of January 20x7 to the end of the year 31st of December 20x7. Again, that's 6 marks, 50% to pass, so you just need 3. Okay, and then part C, much bigger than the others. Statement of financial position for the 31st of December, again 20x7, 8 marks, 4 marks to pass. So if you total that up, you need 10 marks in order to be able to pass out of the 20. And you've got 3 hours 15 minutes on the exam, haven't we? So for 20 marks, it's 1.95 minutes per mark, which sounds crazy, but that's what you need to stick to within the exam. So you need to leave yourself 39 minutes. Okay, no more, no less. Just note you've got those 3 requirements. This is a published company accounts type question. So what you tend to do here is you answer part A, B, and C all together at the same time. Okay, don't answer part A and then move on to part B and then move on to part C, because when you're working through the information given within the question, your answer might relate to part A and also part C, or just part B alone, or maybe parts B and part C. So you've really got to answer the question as one. Hence why we're not separating each of the individual parts out into the individual amount of time allocated. You have 39 minutes to do as much as possible, so keep your eye on your watch. Okay, so what you've got is it's a published company accounts question. You can see the trial balance and then you can see the additional information, and it's important to understand the additional information so that you can approach it in the correct fashion. Because if you skim read them and have a look over them, you can see that the first one looks really complicated. It gives you some discount factors, so steer clear of that one straight away. That's all about convertible loan notes. Second one, again, relatively large, it's about revenue. So part 1 and part 2, convertibles, revenue, they are new to financial reporting, so haven't been seen in financial accounting, unlike number 3, the bonus issue. There's not a lot of information in there either, so that should be pretty easy. Okay, a really strong financial accounting student will be able to do that part of the question dead easily. Okay, part 4, PPE revaluation. Yeah, we've seen that in FA, haven't we? Fine, but yeah, they can be quite tricky, can't they? So we might do that after we've done maybe the bonus issue, because it's brought forward knowledge applied maybe in a more challenging aspect, but we can do it. Okay, and then part 5, something about inventory. Didn't we do that as IS2 way back in financial accounting? We've recapped it in financial reporting. That should be easy. So the key to doing well in this question is to get the easy mark. So start off with either the inventory or the bonus issue, whichever you prefer to do. Then maybe move into the PPE and then finish it off with revenue and then convertibles. Okay, that's how I do it. You may choose to go through there and do it ever so slightly different, but that's your choice. Okay, if you don't do the inventory and bonus issue first because they're easy, you're crazy. Okay, and don't go into the exam. It's simple. You're wasting your time. You're giving more money to the ACCA by volunteering actively to go through there and resit the exam. If you start off with the convertible loan notes and the revenue, yeah, good luck. Okay, easy marks first. Okay, so what we've got there, part A, get yourself a page of paper, or get yourself a sheet on your computer-based exam. Head it up A, adjusted profit. Be clear as to what you're answering. And then there you just need to put in your draft profit figure per the TB. So you've got there, is it a credit entry? It says draft profit for the year ended December X7 at 2250. Put it in. Nothing to it. Tick it off if you're doing the paper-based exam at 2250. Once you've done that, just a bit quick summary. Adjusted profit. We've always looked at preparing the performance statement, the position statement, maybe a statement of change in equity. So what's this adjusted profit figure? Well, let's go back to debits and credits. Okay, remember your mnemonic? Dead click? No? Please say yes. Okay, if you say no, you're about to go in to do your financial reporting exam. If you don't know what a debit is, don't know what a credit is, again, don't go into the exam hall. But debits, remember, debits increase your expenses, assets and drawings, but the focus here in terms of profitability is that your debits increase your expenses. So if expenses go up, profits go down. Okay. Conversely as well, a debit would reduce your income, and if we're reducing income, reducing profits. But it tends to be that debits increase our expenses, reduce profit. Therefore, debits are bad in terms of our statement of profit or loss, bad in terms of profits, and therefore will reduce anything that we have with our adjusted profit figure. Okay. Credits, click. Credits increase liability, income, and capital. Okay, so credits increase your income, therefore that increases your profit. Likewise, credits will also reduce your expenses, which will also increase your profits. So key thing there is that if you've got a credit entry to profit or loss, that's good, and it's going to increase your adjusted profits. So simple rule. Debits, bad, reduce profits. Credits, good, increase profits. Brilliant. Okay. And if you sat there thinking, oh, I don't like debits and credits, I'm not going to think about them, I challenge you to do it because it'll make your life easier. Okay. Part B, let's set it up. It's really good, Part B, to use the trial balance, because you can use the trial balance headings or line items to identify the headings you need on the statement of change in equity. So from top to bottom, you've got share capital, so ordinary shares, other components of equity, retained earnings, and is it your evaluation surplus? Whack those figures in as you brought forward. They're nice and straightforward. Nothing difficult there. Hey, there we go. Woohoo, we got our first mark. Okay, 1 out of the 10 that we are required to go through and pass this question. I'll let you keep tally. I'll forget. Okay. Dividend, again, that comes straight from the TB, doesn't it? 3,620. Put it in brackets. Okay. So is that another half? That's 1.5 down, 8.5 more to go through there and pass. Okay. And then thinking about drawing up my statement of financial position, again using the figures in the TB. Remember, when you write something, leave a bit of space in between because you never know what's going to appear afterwards. So here I've got my assets. You should know how the assets look in terms of non-current and current. My inventory figure that I've got is 4310. I'm not putting that in directly because it's got a bracket in the question. It says note 5. So I'm thinking, well, there's likely to be an adjustment to inventory. And I know from having scanned the additional information at the start that inventory is part of those additional pieces of information and therefore is likely to have an adjustment. And then easy figures, receivables, bank, whack them in. Half a mark each. Are we on 1.5? Yes. We're now on 2.5. Okay. In terms of my equity and liabilities at the bottom of my SFP, don't start filling out anything to do with equity. Everything that you have from Part B feeds in, is it there, to the statement of financial position. Okay, yeah, just checking. Part B was the statement of change in equity. And then going through the TB, easy marks, current liabilities, put that in, that's there as a half. Okay, so that takes us to 3, doesn't it? We were on 2.5. Okay, everybody happy with where we are so far? Yeah, 2.5 out of the 10. Okay, so let's do the easy bits first, shall we? Omitted inventory, that's Part 5. It says it has been discovered that inventory totaling $0.39 million has been omitted from the final inventory count in the above trial balance. Well, if it's been omitted, we need to include it. So we need to include it at the reporting date at 0.39 million. To you and I, 390,000. So just be careful, because everything we're working at is in round thousands. So it's 390, isn't it? Journal entry for inventory. If you don't know this, whoa, what have you been doing? You debit your inventory on the statement of financial position, credit your inventory on the statement of profit or loss as part of cost of sales. But remember, we're not preparing a statement of profit or loss. We are preparing an adjusted profit figure. So that credit is going to go through in part A, and credits are good for profit or loss as they increase your profitability, don't they? Okay, so debit inventory, 0.39 million or 390,000 in part C, and credit your profits in part A with the same 390,000. So if we go back to part A, there we go, 390 on your inventory. That's a mark. So we were on, let me see, was it 1.5, 2.5, 3? So we were on 3, weren't we? I think we're now on 4. Okay, so adding in 390. In terms of my inventory, you add on 390 and you can total that up to give you 4,700. So does that take me to another 1, which then makes 5? So I'm halfway to passing. Okay, in how long? Not long at all. Okay. The bonus issue. In terms of the bonus issue, what have we got? Well, it says in the information they've not recorded it. So it's up to us to record a simple 1 for 5 bonus issue. Okay. So bonus issue, credit share capital, debit share premium, isn't it? And we credit share capital based upon the par value. And here I think the par value was $1. Okay. For some reason, it's very rarely not $1 in the exam, but do keep an eye out. So I need to look at the number of shares that are issued to apply that $1 par. So there are 20 million of them are in issue. It was a 1 for 5. So divide by 5, multiplied by 1. There are 4 million shares that have been issued. Par value is $1, which I can take from the TB. So I need to credit share capital. Is it there with the 4 million? Okay, so 4,000. The natural entry is just a debit share premium with the same 4 million. But be careful, there's a bit of a giveaway in the question in part 3 where it says Haverford Co. intends to utilise the share premium as far as possible in recording the bonus issue. Why would they be telling us that? They're telling us that because there's not enough in share premium. We can't debit it with 4 million if 4 million isn't there. So we're going to use as much as possible, which is the 3 million. So we know that from the TB. And then the rest is just a balancing figure, which is a debit to retained earnings. Okay, which is $1 million. Those entries, what have we got there? Everything that you have, it is into part A. Sorry, not part A, part B. And the statement of change in equity. Part A is the adjusted profit. Okay, we're not adjusting profits. We're just processing an entry to your retained earnings. Okay, we're not touching income. We're not touching expenses. Okay, we're just utilising the retained earnings to swallow up that bonus issue of shares. So remember, we were on 5 marks, weren't we? There we go. Bing, 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 bing. Okay, bonus issue, credit share capital 4. Debit your other components of equity, which is your share premium at 3, and retained earnings get reduced as well by the 1. We're on 5. Get that right. You should be getting that right. I'm sorry. There's no excuse. Okay. Yeah, you could have done that in financial accounting. You can do it in financial reporting. Don't let yourself get all lost because it's a proper written exam. Okay. Or proper computer-based exam. Okay. Where you prepare financial statements. So that's 2. 7. Okay, so that's 7 marks that you have so far. Okay, doing pretty well, aren't we? Okay, so you're well on the way to passing there. Okay, property revaluation, part 4. It's up to you. You can do the revenue, you can do the convertibles. I don't mind. Okay, but remember, if you have a revaluation, you've got your historic cost, revalued, and revaluation surplus or revaluation reserve. I think it's key here to identify within part 4 that they've already done a revaluation upwards. Okay, and that was at the 1st of January X7. So the revalued amount is there at the 18 million. Okay, so 18,000. Be careful, don't put it in the historic cost column. The revaluation reserve we already know as well from the TB and also from part B in terms of your statement of change in equity. It is 800. So we need to work out some annual depreciation. We depreciate that asset based upon its revalued amount over its remaining life, and we're told that the 1st of January it has 25 years. 18 divided by 25 gives me the 720. Can you depreciate an asset? I'd hope so. Okay, if you can't depreciate an asset, what are you doing? You're panicking, that's what, because it's like, oh, revaluation, it's difficult. Read the question, understand the question, get the easy marks. You can get that. You can depreciate the asset. 18 over the 25 years, 720. After that, it becomes a little bit more challenging because you've got the 7280 once you've depreciated the asset, getting it down to its carrying value. If I was in the exam struggling for time, I'd stop, okay, and put those in the appropriate place. However, I just want to complete it and then tell you where to put them. Because what we're told is it then tells us that at the end of the year, December X7, it was valued at 16 million, so you're 16,000. So we currently have it at 17,280. It needs to come down to 16, so there is a balancing figure of the impairment of the 1280. Okay. That 1280, 800 of it is going to go to the revaluation reserve. The remainder is that the 480 goes to profit or loss. Okay. So I've got three figures I need to process. The 720, which you should get. I should also have highlighted the 17,280. Oh no, careful. The 16, which I have, which is the value at the end of the year. And then that revaluation reserve. Okay, the reduction in it. So where are we? Let's go to part A. Depreciation, bang, 1 mark. Okay. So it takes you a step closer to that magical 10. The impairment, I think that's pretty hard. If you get that, great. You get a mark. If not, don't worry. Okay. But I'd expect you to get at least 1 mark there. In terms of the statement of financial position, there's another easy mark there from the working. Even if you didn't do a working, you're told at the end of the year it was valued at 16 million. It's not rocket science. That's where the mark. That's where the mark. Yes, you are given a mark for taking the value at the end of the year 16 and putting it in the financial statements. Wow. Okay. So 1 mark from the plant and equipment, 1 mark for the depreciation is at 9 marks. Okay, so you're within touching distance of being able to go through there and pass the question. Okay, forget about the other bits in terms of the impairment that's gone through part A. Who cares? Okay, not bothered. Don't forget as well, you've got the revaluation surplus of 800. There's a loss there. If you're brave enough or crazy enough, you might just take the whole 800 and hope and remove it all. Whatever you do, it's only half a mark, so don't worry. Okay, you may get that, you may not. Okay, but I'm sticking with we're on 9. We need a mark to pass somewhere. Okay, revenue. What have we got? Although it's new, I think this is reasonably straightforward. You've got a performance obligation over time, so therefore you're going to recognise the revenue, costs, and profit based upon the stage of completion because it is a profitable contract. How can you identify that it is profitable? Well, you can see there, you take your revenue, less your total costs, being your cost to date and cost to complete. So straight from the question, you've got the 14 million, 1.9 and 7.1 million. So that gives me a profitable contract of 5, of which it is 40% complete. Okay. So you've got to get these. Okay. You're just given numbers and need to take 40% of them. 40% of the revenue, 40% of the cost, give you 5,600 and 3,600. That's it. Hang on a minute. That's increasing revenue, increasing costs. Surely those two numbers there are going to impact my draft profit. Okay, so did we say we were on 9? I may be out by a half mark here or there, but let's say 9. Boom! Revenue, 5,600. Boom! Costs, 3,600. Boom, boom! 1 and 1. 11, pass, brilliant, pen down, walk off. Don't. You've got other bits to do, but you've got 11 out of the 20. Okay, is that 55%? There you go. If you want to pass, that's how you do it. Okay. If you want to get full marks, mess around with the impairment, mess around with the next bit. Oh, geez. Revenue, you need to look at things from the statement of financial position perspective as well. So what are we going to recognise with regard to our contract asset? So you take your cost to date, which are 1.9 million, your profit to date, your own figure, and it says We've received 1.4 million. So there we go. So that's the amount billed to date. So that reduces the value of the contract asset because we received the cash. Or if you like, you've transferred it to receivables. It actually says received. So yeah, it's been billed. So we've got the cash. So you've got 2,500. That 2,500 we said earlier on to leave space, didn't we? Pops in there into your assets as a contract asset. Okay. Yeah, rock solid. But you're sat there going, yeah, who cares? Okay, you're waving to your friend going, what are you messing around for? Don't. Because you get maybe a mark for it. It's the higher skills, harder stuff. Who cares? You're on 11. Well done. Brilliant. Convertibles. Convertibles are a funny one because we see them quite a lot. If you get them, you can nail it, okay? Because it very rarely changes in terms of the style. Just a bit of a recap in terms of what you do with your convertibles. So remember, you're using split accounting, so you need to credit equity, credit a liability. To work out the liability, you have to discount back the maximum amount of cash that you're going to pay to present value using a discount rate on is it similar debt without the conversion option, so the market rate of interest. And then once you've worked out your debt element, the difference between the debts, so the liability, and the proceeds, the balancing figure is the equity element. If you want an easy mark in the exam, work out the proceeds, have a stab at the liability, and then get the equity as the difference. You'll get marks as your own figure. Okay. So convertible loan notes, total proceeds, liability, equity is the balancing figure. Here we issued 80,000 loan notes at $100 par. So with my maths, I think is that if I'm working 1,000, it's 8,000 because that's 8 million, isn't it? Okay. In terms of my liability, what have we got? Separate working. You need to discount the cash flows, which first of all are the coupon interest. So we know the par value is 8 million. Coupon rate is 4%, so we're going to be paying 320,000 back each year. So when I'm then discounting that back, is it 3 years? Is it 20x7? And redeemed in December x9, so 7, 8, 9, 3 years. Bit of a giveaway, given that you've got 3 years worth of discount factors. Okay. The cash payments that you make are 320 for the 3 years. Don't forget you've also got the principal, the 8 million to redeem at the end of the 3rd year. Remember, we make the assumption that everybody redeems for cash, assuming that there is no conversion option. Discount factor, not the 4%, not the coupon rate. We use the 6%. Is it the market rate of interest? So similar loan without the conversion rights. So 0.943, 0.89 and 0.84. So when you get all those questions on the discussion forum, I can't calculate the discount factor, it's given to you in the exam. Remember, take the payment, multiply by the discount factor to give you the present value. You then total that up, and I think your liability is 7,576. I could not care less if you get that right or not. Okay, have a go, be quick about it. If you're struggling, make up a number. Why? Because when you put in the liability of 7,576, you want to get the equity figure, which is there at 424, don't we? Okay, yeah, 424 for the equity, because that's going to get you the marks. Okay, why? Look, separate column, convertible bonds, equity option, your figure 424. Total that will get you some marks as well. Okay, I think there was it half or maybe even one going for that there. It'd be half, I think. So half, that makes, if we say we're on 11, you're on 11 and a half. Okay, there we go. The equity option. And that equity option gives you, is it the 424 and half a mark. Okay. You can put your convertible loan notes figure in, but just be careful. This is rock solid. Because what you've got that liability figure at 7,576, and these convertible loan notes were issued on the 1st of January. So that's the start of the year. Okay, we need to work out what it is at the end of the year. Woo, that's rock solid. Okay, proper testing you to the max. So you've got your opening figure of 7,576. You charge interest at 6% on that outstanding liability. We know that we pay the 320 to give you then the carry forward figure of 7,711. So we're then treating the liability, aren't we, at amortized cost. What use is that? No use if you haven't got it. If you have got it, great. You've got interest of 455 in part A. So that's going to go through there and reduce your profits. And then on the statement of financial position in part C, you've got your closing convertible loan notes balance. So you've got your convertible loan notes at 7711. If you want, you've then got your interest at 455. Okay, I'm not even going to go through there and give you a mark for it. There is a mark to take it to the 6, but you're not going to get it. Okay, you're doing it at the end. You're under pressure. You're all over the place. Who cares? So when you total up the adjusted profit, it's 3305. On my statement of change in equity, I can go through there, put in your profit, your own figure, because that's half a mark. Okay, whatever figure you've got from part A goes in there to your retained earnings. So I think we're now on about 11.5, maybe even 12 marks. That's 60% nearly on the question. Now I've done it in way shorter time than what is available in the exam. Total up the share capital, total up the retained earnings. Because then what you've got is, what was the figure? 24,4955. 24,000 equity shares, 4,955 retained earnings, share premium nil. Boom. If you want, and if you've got time, you can total up the equity and liabilities. You can total up the assets. Hopefully they balance. If they do, woohoo. If not, who cares? You don't get any marks if they do or don't balance. Okay, so I've shown you how to pass the question. That's the most important thing. I've also gone through there and shown you everything about the question so you can then try and maximize your marks. It's not just about knowledge, it's about approach as well. And the better your approach, the better you will do within the exam. Good luck.